$25 billion wealth fund built on borrowed money, a prime minister with millions in stock options in the sectors the fund targets, and the committee has been slated to be restructured the same day it flagged this conflict. On today's episode of Beyond the Headlines, hosted by Critical Chris. Hey everyone, welcome back. Before we get into it, if you find value in this kind of reporting, please like, subscribe, and hit the notification bell. It genuinely helps get this content in front of more Canadians. And if you want to support the channel directly, head over to criticalchris.com. Every donation helps keep the work going. So what's the scoop? On April 27th, 2026, just the other day, Prime Minister Carney announced Canada's first national sovereign wealth fund. He called it the Canada Strong Fund. $25 billion, nation building, generational wealth. There's just one problem. Canada doesn't have a surplus. It has deficits. And that single fact changes everything about what this announcement actually means. The federal government would contribute $25 billion over 3 years. It would co-invest with private capital in energy, critical minerals, infrastructure, agriculture, and technology. Returns would be reinvested to grow the fund, and eventually ordinary Canadians would be able to buy in through a retail investment product. It would be set up as an arm's-length crown corporation with an independent board and CEO. It was framed as a generational investment in Canada's future. Before we can evaluate that claim, there's one basic question that needs an answer. Where's the $25 billion coming from? A sovereign wealth fund, by definition, is built from wealth a government already has. From revenues it has saved. Canada isn't saving revenues right now. Canada is running structural deficits, meaning it spends more than it takes in year after year after year after year after year after, you get it, and has been doing so for, well, ever since the Liberals took office. The $25 billion for this fund isn't coming from saved wealth. It's going to be borrowed. It's going to be added on top of a debt load that's already nearly $1.3 trillion. Statistics Canada reported the federal government posted a $12.3 billion deficit in Q4 2025 alone, up from $11.1 billion in the same quarter the year before. Across all levels of government combined, the quarterly deficit was $20.8 billion, with spending growing at 4.3% while revenue grew at just 2.4%. For the first 11 months of the 2025-26 fiscal year, the Finance Department's own fiscal monitor recorded a $25.5 billion deficit, up from $19.3 billion for the same period a year earlier. The government's own budget 2025 projected a $78.3 billion deficit for the full fiscal year. That's 2.5% of GDP. The Parliamentary Budget Officer reviewed those numbers and found only a 7.5% probability that the government would even meet its own declining deficit to GDP target over the next 5 years. Federal net debt stood at $1.2665 trillion as of March 31st, 2025. That's up $30.3 billion in a single year. The annual cost of servicing that debt, just paying the interest, hit $53.4 billion in 2024-2025. That's roughly 10 cents of every federal dollar spent before a single program, transfer, or service is funded. The Canadian Taxpayers Federation projects those interest charges will rise to about $60 billion this fiscal year, more than the federal government sends to the provinces in health transfers and more than all GST revenue collected. The Fraser Institute found that the federal per-person debt in 2025 is projected at $56,432, the highest in Canadian history outside of COVID. A separate Fraser analysis calculated that Canadians aged 16 to 80 today will collectively pay an additional $332.5 billion in personal income taxes over their lifetimes because of recent federal debt accumulation alone, roughly $10,500 per person. Those aged 25 and under will carry 35.5% of that load. Those 65 and over will carry 2.7% naturally. Every additional dollar borrowed right now makes those numbers worse. When reporters asked where that $25 billion was actually coming from, Carney pointed to the upcoming spring economic update, noting that the deficit's tracking below the November projection. RBC Economics confirmed the deficit's running at roughly 1% of GDP versus the planned 2.4% for 25-26. But this is helped because of higher oil prices from the Iran, US, and Israel conflict. A deficit tracking below projection is still a deficit. The government is still adding to the debt. A better than expected hole isn't savings. As CTF Federal Director Franco Terrazzano put it, Norway uses its sovereign wealth fund to save money and only spends the interest. But Carney's fund is built on borrowed money and will gamble taxpayers' money on corporate handouts. When you borrow money to seed an investment fund, the fund's returns have to beat the cost of the debt, after fees, after inflation, after losses. Or the taxpayers are left covering the shortfall. The government hasn't provided a single independent analysis showing that's likely. No break-even modeling, no minimum return threshold, no projected returns against borrowing costs, just an announcement. The government used the term sovereign wealth fund deliberately. It evokes Norway. It evokes general wealth. It evokes responsible, forward-looking stewardship. So it's worth spending some time on what that term actually means, because the comparison doesn't hold up. And understanding why it doesn't hold up is essential to understanding what the fund actually is. Norway's government pension fund Global is the largest sovereign wealth fund on Earth, holding over $2.2 trillion US in assets as of April 2025. That's equal to roughly 1.5% of every listed company in the world. It was built from petroleum surplus revenues. Norwegian law requires the full net cash flow from oil and gas extraction to flow directly into the fund. Annual government spending from the fund is capped at the long-run expected real return. That's roughly 3% per year. The underlying capital is never touched. There's one more feature that sets Norway apart, and it's the most important one. The fund invests entirely outside of Norway. This is across roughly 7,200 companies in over 70 countries. There's a legal prohibition on investing domestically. That rule exists for a specific reason: to prevent the government from using the fund to pick winners in the Norwegian economy, to keep political priorities away from investment decisions, and to diversify Norway's public finances away from the same oil price risks that already dominate their economy. The Canada Strong Fund does the exact opposite: explicitly domestic mandate. It's designed to invest in Canadian projects. The rule Norway built to protect its fund from political capture isn't a design feature of the Canada Strong Fund. In fact, it is the complete opposite. Closer to home, Alberta's Heritage Savings Trust Fund was created in 1976 with an initial $1.5 billion drawn from existing provincial revenues, not new borrowing. It's been funded over the years from a legislated share of non-renewable resource royalties. Recent contributions came entirely from actual budget surpluses: $753 million in 2023, $2 billion in 24, and $2.8 billion for 25-26, all from prior year surplus cash. As of December 31st, 2025, the fund held $31.9 billion in net assets. Alberta's fund is also a cautionary tale. The Fraser Institute has documented that despite over $190 billion in non-renewable resource revenue flowing through the province since 1980, the fund is only worth $31 billion today. Contribution rates were cut every time oil prices fell. Earnings were pulled for general spending. There are no constitutional protections preventing a future government from doing the same again. In other words, even a correctly designed fund can be slowly dismantled by weak rules. That lesson matters here too. Norway built its fund from oil surpluses and invested globally with strict rules keeping politicians out of the decisions. Alberta built its fund from provincial surpluses and invested domestically. Both started from a position of actual wealth. The Canada Strong Fund starts from a deficit, borrows its seed capital, and invests domestically with a political mandate to target specific sectors. Scotiabank economist Derek Holt noted on announcement day that countries with sovereign wealth funds are normally net savers. University of Toronto economist Joseph Steinberg put it plainly: the fund's actual purpose is to invest government debt in domestic infrastructure projects that haven't attracted private investment for their own reasons. That last part is worth sitting with. When private investors choose not to fund a project, that's a signal. It usually means the expected return doesn't justify the risk. Government money doesn't change the economics of a project. It changes who absorbs the losses when that signal we talked about turns out to be right. Everything covered so far, the borrowed capital, the failed design comparisons, the absence of any return analysis, would be a serious story on its own. But the primary focus of the story is that the Prime Minister who created this fund has a documented financial relationship with the sectors it's designed to invest in. Shocker. That relationship didn't begin when he became Prime Minister. It didn't begin when he entered politics. It goes back years. You guessed it. Brookfield. Before entering politics, Mark Carney served as chair of Brookfield Asset Management, one of the largest alternative asset managers in the world with roughly $1 trillion US under management across infrastructure, real estate, renewable energy, and private equity. Those are the same sectors the Canada Strong Fund is mandated to target. This isn't coincidental overlap. Brookfield is one of the most dominant players on Earth in exactly the territory this fund is being directed. When the Ethics Commissioner published Carney's mandatory financial disclosures in July of 2025, the picture became concrete. He held options and deferred shares in both Brookfield Asset Management and Brookfield Corporation. As I've already touched on in the past, according to Brookfield's own 10-K filing with the U.S. Securities and Exchange Commission, those unexercised stock options were worth $6.8 million US as of December 2024. He also held positions in over 500 other companies through a managed investment account. Okay, I've discussed all of this before, as I just said, but here's something that hasn't been covered on this channel yet. In September 2024, Prime Minister Trudeau appointed Carney to chair the Liberal Party's task force on economic growth. That role gave him direct influence over the government's economic policy agenda. Within weeks of that appointment, investigative outlet The Logic reported that Brookfield Asset Management, the firm Carney was still chairing, had been in active discussions with Canada's largest pension funds and the federal government about a proposed $50 billion domestic investment fund. Brookfield called it internally the Maple Fund. Yeah, sounds an awful lot like the Canada Strong Fund. The structure was straightforward. Brookfield would put in $4 billion, pension funds would contribute $36 billion, and the federal government would contribute $10 billion. Brookfield would administer and manage the entire vehicle. The pitch materials described the Maple Fund as the largest ever private pool of capital dedicated to investing in the Canadian economy. The target sectors: housing, data centers, nuclear energy, telecommunications, and infrastructure. Those overlap almost entirely with what the Canada Strong Fund is now targeting. Do you see where I'm going with this? The materials also flagged potential opportunistic situations, including privatizing Crown Lottery corporations and other public assets. Brookfield would have collected management fees on every dollar deployed. There's a critical detail about Carney's position during all of this. Because he was employed by the Liberal Party rather than the Prime Minister's office, he wasn't subject to the standard ethical disclosure requirements that apply to official government advisors. He was simultaneously chair of Brookfield, the firm actively seeking $10 billion from the federal government, and the PM's own economic growth advisor with no mandatory obligation to disclose that dual position. Pierre Poilievre raised this directly during question period in the House of Commons, asking why Carney hadn't been placed on government payroll where conflict of interest rules would apply. You know what Trudeau did? He dismissed the question. The Maple Fund didn't proceed. Pension funds cooled on the idea. The Globe and Mail reported this was partly because of potential for perceived conflicts of interest. One source with direct knowledge of the discussions told The Logic that Carney's dual role made the proposal hugely problematic. The timing made everything worse. In October 2024, 6 weeks after Carney's task force appointment, while Brookfield was still pitching the federal government on the Maple Fund, Carney traveled to Beijing for the Financial Street Forum and met with the city's mayor. Shortly after that, Brookfield secured a $276 million loan from the Bank of China to refinance distressed Shanghai real estate holdings. The House of Commons Ethics Committee cited this sequence specifically when it issued its April 2026 divestment recommendation, because it shows Carney's government activities and Brookfield's business interests were running in parallel during a period when no disclosure was required of him. Now Carney is Prime Minister. He has announced a $25 billion fund with the same domestic mandate, the same target sectors, and the same basic structure as the Maple Fund his former employer pitched to the government he was simultaneously advising. The Canada Strong Fund's manager hasn't yet been named. That being said, Brookfield would have been the Maple Fund's manager. We'll see what happens there. Regular viewers of this channel will recognize the pattern. In episode 1 of Beyond the Headlines, just released the other day, we covered Bill C-28 and the Canadian Space Launch Act, a $200 million federal lease flowing to Maritime Launch Services, a company connected to Carney's personal orbit, and over $2 billion in federal loans to Telesat, run by Carney's publicly documented close friend Dan Goldberg. The structure there was exactly the same. A government funding vehicle directed at sectors and companies tied to the Prime Minister's personal and professional network, with an ethics screen that operates in secret and requires public recusals that weren't being posted as legally required. The Canada Strong Fund fits that pattern, scaled to $25 billion. When Carney became Prime Minister, his assets were placed in a blind trust, and a conflict of interest screen was established, as we've already talked about. For those who have been following our On Politics episodes or the earlier coverage of this conflict, you already know the mechanics here. The screen covers roughly 100 named Brookfield-related entities. It's administered by Carney's own chief of staff and the clerk of the Privy Council, and Carney is barred from participating in decisions that directly name those entities. What this report covers is what Parliament's Ethics Committee discovered the screen can't do. In the House of Commons Ethics Committee in November 2025, Brookfield's own Chief Operating Officer Justin Bieber, is it Justin Bieber or Justin Bieber? We'll say Justin Bieber for fun, was placed under oath and asked directly, as Brookfield's performance increases, does the value of the instruments Carney holds also increase? Bieber answered, Bieber answered, yes, as the value increases, the value of those instruments also increases. The committee also established something more specific. The screen's administrators, Carney's chief of staff and the clerk of the Privy Council, have no visibility into the assets inside the Brookfield Global Transition Fund. That fund is the vehicle from which Carney stands to receive future bonus compensation worth potentially tens of millions of dollars based on the fund's performance. That fund invests in clean energy and infrastructure. The Canada Strong Fund's mandate is clean energy and infrastructure. The screen can't protect against a conflict of interest it can't see into. York University ethics law professor Ian Stedman, who specializes in government ethics, was direct. We've never had someone hold this level of public office whose assets are so diverse and the quantity so high. The screen only covers roughly 5 to 10% of Brookfield's full corporate empire. Broad government policy on energy, infrastructure, tax credits, and the green transition, all of which directly affect Brookfield's portfolio, falls outside the screen entirely. As we documented in On Politics Episode 3, Carney can steer big picture policy across every one of those areas without triggering a single restriction. A $25 billion fund investing in those areas isn't a specific named decision. It's exactly the kind of broad policy action the screen was never designed to catch. On April 23, 2026, 4 days before the Canada Strong Fund was announced, the House of Commons Ethics Committee tabled a formal report. We've talked about this. Its recommendation: Prime Ministers should be required to fully sell their investment portfolios upon taking office, not merely placing them in a blind trust. Ethics watchdog Duff Conacher of Democracy Watch was unambiguous. If that recommendation were enacted, Carney would essentially be required to sell his Brookfield holdings entirely. On April 23rd, Parliament says the conflict of interest safeguards are insufficient and Carney should divest. On April 27th, Carney announces a $25 billion fund targeting Brookfield sectors. And on that same day, the Liberal government moved to restructure every parliamentary committee so that Liberals hold a majority on each one, including the Ethics Committee that had just issued the divestment recommendation. The Conservatives proposed an amendment to at least protect opposition balance on 3 specific oversight committees: public accounts, government operations and estimates, and access to information privacy and ethics. Government House Leader Stephen McKinnon's response? The answer is no. The Hub drew the direct parallel to the We Charity scandal under Trudeau. Investigations that only happened because the Liberals were in a minority parliament. A political science expert cited in the Hub noted that majority governments have a much easier time preventing committees from launching embarrassing inquiries. The committee that recommended Carney divest is now being restructured to give it a Liberal majority. Okay, so this is a lot. So I'm going to provide a timeline of this conflict in sequence. September 2024, Carney chairs Liberal Economic Task Force while still heading Brookfield, with no mandatory disclosure obligations. Weeks later, Brookfield pitches the federal government for $10 billion to manage a $50 billion domestic fund. October of 2024, Carney travels to Beijing. Brookfield secures a $276 million Bank of China loan on distressed Shanghai real estate. In January of 2025, Carney announces his Liberal leadership and resigns from Brookfield. March of 2025, Carney becomes Prime Minister. April 23, 2026, the Ethics Committee formally recommends full divestment. 4 days later, April 27, 2026, Carney announces the Canada Strong Fund. April 27th, that same day, the government moves to take majority control of the Ethics Committee. Even if you set all of that aside, what does the evidence from other countries tell us about what happens when a government creates an investment fund with weak oversight, political project selection, and no binding accountability? The Carnegie Endowment for International Peace published a major study in June of 2024 examining exactly this. Their conclusion was unambiguous. Without detailed financial and operational information, the door is left wide open for rapacious managers and political elites to misappropriate investment earnings. They found this outcome repeats across countries and political systems when the same structural conditions are in place. For example, in 2009, Malaysian Prime Minister Najib Razak created One Malaysia Development Berhad, or I'm just going to say 1MDB because that's a lot easier. It was announced as a nation-building vehicle for economic development through international partnerships. Najib chaired its board of advisors and held sole authority to approve investments. The U.S. Department of Justice later described it as the largest kleptocracy case in the history of its asset recovery program. Between 2009 and 2015, investigators found more than $4.5 billion US was stolen from the fund. Najib funneled over $700 million into his personal accounts. Goldman Sachs paid a $2.9 billion settlement for its role, one of the largest in Wall Street history. The fund's accumulated debts reached $12 billion. The Malaysian government ultimately assumed all of 1MDB's liabilities. Najib was convicted in 2021 and sentenced to 12 years in prison. Not a bad trade-off. The structural conditions that made it possible: the PM chaired the oversight board. He had sole signing authority. There was no independent audit mechanism with real enforcement power. Parliament had no effective oversight role. Public disclosure was also minimal. So let's turn to the Canada Strong Fund. It will report through the Minister of Finance. Its governance rules are still being designed. The committee that would scrutinize it has just been restructured to give the government a majority. Uncanny similarities. Russia's direct investment fund was established in 2011, presented as a tool for attracting legitimate international investment. In February 2022, the U.S. Treasury's Office of Foreign Assets Control sanctioned it and its CEO using the language, "While officially a sovereign wealth fund, RDIF is widely considered a slush fund for President Vladimir Putin and is emblematic of Russia's broader kleptocracy." The Treasury documented how the fund directed benefits to political allies and served as a mechanism for elite patronage. The enabling conditions: a domestic investment mandate and political project selection with no binding independent oversight. Both of those features are present in the Canada Strong Fund. Third example, Hugo Chavez. He created FONDEN, a $100 billion off-budget fund drawing from oil revenues above a set price threshold. It operated with zero independent oversight. Over 25 years, Venezuela received over $1 trillion in oil revenues. What remains today is a collapsed economy, $154 billion foreign debt, oil production at a fraction of what it used to produce, and nearly 8 million people who have fled the country. That was all happening until Donald Trump overthrew its falsely elected President Maduro this past January. Venezuela isn't just a story about stolen money. The Council on Foreign Relations documents how Chavez used the state investment vehicles to consolidate political power, ending presidential term limits, nationalizing private businesses, and using state funds to buy loyalty. The investment fund was the financial arm of that consolidation. Government investment vehicles with no real accountability don't just lose money. They become instruments of control. The Carnegie Endowment identified the shared features: concentrated political control over investment decisions, limited public disclosure, weak audit enforcement, and the use of the fund to benefit politically connected actors. Their key finding: sovereign wealth funds usually reflect the quality of governance of the states that sponsor them. None of these countries set out to build a corrupt fund. 1MDB was announced as nation building. RDIF was presented as a legitimate investment vehicle. FONDEN was framed as sharing oil wealth with ordinary people. The framing is never the safeguard. The governance structure is. At launch, the Canada Strong Fund has no legislated investment criteria, no minimum return threshold, no binding independent audit requirement, a retail product that channels ordinary Canadians' personal savings into politically selected projects, and an oversight committee being restructured to reflect the Liberal government's unelected majority. If the international examples feel too distant, there's a domestic precedent that's harder to dismiss. The Canada Infrastructure Bank was created in 2017 with a $35 billion mandate built on the exact same premise as the Canada Strong Fund, a crown corporation that would co-invest with private capital in infrastructure and strategic projects. The promise was the same: attract private money alongside public anchor investment, get projects built, generate returns. What actually happened is the most relevant evidence available for what this fund is likely to produce. The Parliamentary Budget Officer reviewed the bank and found it had committed only 11.5% of its $35 billion mandate in its early years. And every dollar of co-investment that did happen came from other public sector sources: provincial governments, municipalities, and the Quebec Pension Plan. Not a single dollar from private capital. The bank that was supposed to attract private investment attracted none. A July 2025 PBO update projected the bank would ultimately disperse only $14.9 billion of its $35 billion over its full 11-year life, a $20 billion shortfall. It wasn't on track to meet a single one of its 5 sector-specific investment targets. The House of Commons Transport Committee studied the bank and found it received 420 project proposals, but committed to only 13, an 82% rejection rate with no public explanation for any of the rejections. The committee's single recommendation in its May 2022 report: shut the bank down. The NDP and Conservatives reached the same conclusion independently. You want some examples of the absolute failure? Mapleton Water Project, $20 million committed to privatize municipal water services, cancelled after the local council spent hundreds of thousands in legal and negotiation costs. What was built? Nothing. Lake Erie Connector, $899,318 in consultant fees for an electricity transmission project that never broke ground. It was abandoned. The bank also refused to disclose its bonus policies to Parliament, citing competitive and privacy considerations for a Crown corporation funded entirely by taxpayers. The founding chair and first CEO both resigned in April 2020 amid broad criticism of performance and transparency. Total output: 7 completed projects in 8 years. Let's tie this back to the Canada Strong Fund. Desjardins' chief economist, Jimmy Jean, said it plainly on the day of the fund's announcement. The really big question is, how is this fundamentally different from what we've seen in the past? We've had a series of funds that haven't really delivered. Carney's answer to this history is that the infrastructure bank provided debt financing, while this fund takes equity stakes. Equity stakes absorb losses first. They carry more downside than loans, not less. And the political pressures that drove every infrastructure bank failure, the pressure to fund marginal projects for political reasons, the opacity around project selection, the resistance to public accountability, all apply directly to this fund. None of the conditions that caused the failure have been addressed, only the instrument has changed. So now we're going to address the most fundamental question of all. Even if you put aside the borrowed capital, the failed precedent, the conflict of interest, and the international warnings, would this fund actually solve Canada's investment problem? The answer from the research? No. And the reason matters. The C.D. Howe Institute's December 2025 analysis documented that Canadian business investment per worker has been falling since 2015. What happened in 2015? By 2025, Canadian workers received only 70 cents of new capital for every dollar invested per worker across OECD countries, and only 55 cents compared to American workers. Investment in non-residential structures per worker is down 32% from its 2014 peak. Machinery and equipment investment per worker is down 29%. The capital stock per worker is actually shrinking. Canada isn't replacing its existing capital fast enough. By 2024, Canada generated about $143,000 of economic output per available worker, compared to almost $200,000 in the US. Other OECD countries that Canada once outperformed now produce more per worker on average. The C.D. Howe Institute identifies the causes specifically: a hostile regulatory environment for resources development since 2015. Again, what happened in 2015? A structural bias toward residential construction over productive investment, rising government consumption crowding out private investment, and tax distortions that have widened since U.S. tax reforms in 2017. So what happened in 2017 was the U.S. made major cuts to its tax rates under Donald Trump's first term, giving Canadian businesses a far more attractive alternative for operation over Canada's bloated tax rates. The Institute's recommended solution is regulatory reform, tax reform, and reducing government's footprint in capital allocation. The same analysis notes that roughly 80% of federal business subsidies harm rather than help Canada's economic performance. The investment gap is a policy problem. It isn't a problem of insufficient public money. When the federal government borrows $25 billion and deploys it into domestic markets, it competes directly with private investors for the same projects and assets. Firms with government connections and knowledge of the political allocation process are better positioned to win. Less connected competitors are put at a disadvantage. When private investors have already passed on a project, that decision is a signal about expected returns. The fund's political mandate overrides that signal, and taxpayers absorb the cost if the signal was right. The C.D. Howe Institute calculated that achieving fiscal sustainability for Canada would require increasing the combined federal-provincial primary balance by about $43 billion, or 1.4% of GDP, starting now. Borrowing $25 billion for a new investment vehicle moves the needle in the wrong direction. The retail investment product as part of the fund deserves its own mention. The plan is to eventually let that ordinary Canadians invest their personal savings into this fund alongside the government's capital. Retail investors will share in the downside of whatever projects the government selects. Large institutional players who understand how political allocation processes work and who have the resources to influence them are better positioned to capture any upside. The fund is being sold to Canadians as shared national prosperity. What it actually does is channel personal savings into a government-directed portfolio, with the government deciding which projects are investment worthy and ordinary savers absorbing the losses when those decisions are wrong. All right, let's summarize all this, shall we? The Canada Strong Fund is $25 billion in new government borrowing piled on top of nearly $1.3 trillion in existing federal debt by a government that the Parliamentary Budget Officer gives a 92.5% chance of missing its own fiscal targets. It uses the name Sovereign Wealth Fund while violating the foundational principle of every real sovereign wealth fund in existence, which is that you build them from surplus wealth, not from borrowed money, and you keep political priorities away from the investment decisions. The Prime Minister who announced it spent years as the chair of the company that's the dominant player in the sectors this fund will now invest in. His former employer pitched a structurally identical fund to the government he was advising, with no mandatory disclosure obligations on his part, and that pitch was abandoned precisely because the conflict was too visible. The Ethics Committee recognized the problem 4 days before the announcement of the fund, formally recommended he sell his holdings, and was answered on announcement day with both the fund's creation and the restructuring of the committee itself. The international record on funds with these structural features: political project selection, concentrated executive influence, minimal disclosure, weak oversight, from 1MDB in Malaysia to RDIF in Russia to FONDEN in Venezuela, not one of those funds was announced as a plan to fail or to be corrupted. They all failed for the same reason. The governance structure made failure easy and accountability hard. The Canada Strong Fund is launching with governance details still to be designed, and the committee that would scrutinize it being handed over to a Liberal majority. And the economic case for it doesn't hold. Canada's investment problem is driven by regulatory barriers, tax distortions, and government consumption crowding out private capital. Adding $25 billion in borrowed public money on top of the same policy environment that created the problem doesn't fix it. It adds to the debt load that younger Canadians will spend their working lives paying off. Pierre Poilievre asked a question at the announcement press conference that hasn't been answered. If a project has a business case, why would the government need to fund it? If it doesn't have a business case, why would the government want to fund it? It hasn't been answered because there's no comfortable answer. If the projects are commercially sound, private investors will fund them. If private investors won't fund them, the question of why taxpayers should is one the government doesn't want to have. That's it for episode 2 of Beyond the Headlines. If this report added something to your understanding of what's happening in this country, please share it, leave a comment, and let me know what you think. For more coverage on stories like this, check out In Focus and The Roundup right here on the channel, and tune in to On Politics for the live conversation. Chris out.